Hi, and welcome to the fourth quarter market review and outlook. My name is Jason Gunkel, and I lead our investment team here at Severson Strege. This quarter, we have a special guest. Please welcome Lance Gunkel, who is our Managing Director and also a member of the investment team. So Lance, thanks a lot for joining us today. Lance is going to help us to recap 2023 and also look forward to what we might expect from the markets in 2024. So Lance, it was a good year for the financial markets. It maybe took a while, but it looks like we're going to end the year on a high note. And we're recording this just a couple days before the end of the year. But the U.S. market is up now around 26%. Developed international markets a little behind that, but still very good year, up close to 17%. The real estate market, global REITs up close to 11%. They were down most of the year, but had a nice rally, and they look like they're going to finish the year up. And then the bond market is also, looks like it's going to finish the year up about 5% or so. So it's been a bit of a roller coaster ride from quarter to quarter, but starting in November, we got a nice market rally through the end of the year, and that really propped up those numbers. So Lance, there has been a bit of variance throughout the stock market this year. Do you want to talk about some of that variance and some of the areas that did better than others?
Yeah, as investors, we can categorize stocks in two buckets, growth and value. And this year, 2023, growth outpaced value by quite a substantial margin, which is the opposite of what happened last year. In fact, the Magnificent Seven technology stocks, which are in that growth bucket, represented 70% or nearly 70% of the return for the total market. There was also a comeback in the bond market, Jason, after 2 years of negative returns.
Yes, we finally got that bounce back in the bond market that we've been waiting for. Last year was one of the worst years ever for bonds. If bonds ended the year down this year, it would have been 3 years in a row that they had negative returns, which would have been the first time in history. But luckily, some interest rates started falling, and in November, we got a big bounce back where bonds were up about 4.5%, and it looks like we're going to end the year with bonds up over 5%. Bonds right now are offering some very attractive yields, and it is a good time for investors to still take advantage of those yields. They can buy treasury bonds that are still offering 4% rates or so. The corporate bonds, depending on the quality, are 5 to 6% returns. And then higher yielding bonds are 8% or more. So some very attractive yields still out there. And then as rates might start to fall next year, bond prices get an extra boost when rates fall. So we could be looking at a really good year in 2024 for bond total returns. Lance, heading into 2023, I remember reading a Wall Street Journal article. They take a census of economists, and the majority, I think around 60%, thought we were going to have a recession this year. Luckily, they turned out to be wrong. And now I read an article recently, a very similar one, that said the majority of economists think we're not going to have a recession next year either. So Lance, do you want to talk a little bit about this optimism and why economists now are fairly optimistic?
Yeah, economists may not always get it right, but we do follow what they're saying. And I believe that there are three primary reasons that they're optimistic going into 2024. The first reason is that the unemployment rate has stayed very low throughout the course of 2023. We're now at under 4% in unemployment rate, which means that for anyone who wants a job, or for most people who want a job, they probably have one. And that also helps boost consumer spending. The second reason is that inflation has leveled out to a more moderate rate. We saw peak inflation at just over 9% in 2022, and that number is now just a little bit over 3%. So people may still be feeling some of the effects of higher prices, but it looks like any fears of runaway inflation should be tempered at this point. And then the third reason is that as inflation has lessened, this means that the Federal Reserve may be more likely to stop interest rate hikes. A recent forecast or a survey by the Wall Street Journal, where they asked economists what they expected the Federal Reserve to do, said that the majority believe that the hike that occurred this past July was likely the last hike, and the majority anticipate, in fact, a rate decline or a rate cut sometime by the second quarter of 2024. So these are all reasons to be optimistic going into the new year, but they're not the only things that investors will be looking at. What are some other things that the markets may consider for next year?
Yes, well, we do have a presidential election next year, and there'll be a lot of attention paid to that. The good news, I think, is that historically the market can do very well in a presidential election year. I think the market's averaged, over the last 100 years almost, a return of about 11.5% in a presidential election year compared to the overall average of about 10%. The market does do the best historically when there's no presidential election or midterm election, but the market can do very well and has done very well during presidential election years. Another thing we'll be paying close attention to is money market asset levels. So a few things have contributed to money market levels being at near historic highs still. Coming out of the pandemic, people had built up a lot of savings. And then those money market rates rose to over 5% in many cases. So it was a good place to store some cash to earn a good amount of interest. And then also last year, not being a very good year for the markets, I think people piled up a little extra cash as well. But heading into next year, these high levels of cash tends to be a bullish sign for the stock market. And the next few years, at least historically, after the cash levels peak, the market does very well the following few years. And now that the market's done well in 2023, you could start to see people maybe taking money out of cash as those rates likely come down next year and start putting it into the stock market, which could provide an extra boost. And then finally, what really drives the stock market over the long term is company earnings. And we had a year this year where company earnings were pretty flat compared to last year. And last year was a really good year for company earnings growth. And so it makes sense that this year would not be quite as strong. People were focused on interest rates and inflation, which luckily still boosted the markets this year. But next year, we could start to see more of a focus again on company earnings. And the surveys really for the S&P 500 companies are quite positive. I think we're supposed to get double-digit earnings growth next year, maybe 11.5% is the forecast from FactSet. And if we do get that high of earnings growth next year, it would be likely, I think, that prices rise as well. So there's definitely reasons to be optimistic as we head into 2024. Our investment team will stay on top of the news and keep our clients informed. But thank you so much for joining us for this quarter's review. Happy New Year to you and your family, and we look forward to seeing you next year.